Indians now owe about 18.6 lakh crore rupees against their gold jewellery. That's not a typo. Gold loans are now one of the largest retail loan segments in the country, and this pile grew by about 50% in a single year. Today on Decoder, we're decoding why gold loans can feel like a useful tool, but at the same time, they could quietly be turning into India's next household debt problem. This episode is not about gold prices or which jewelry to buy. It's about three questions you rarely see in the ads. Why are gold loans suddenly the hero of retail credit in 2026? Why did India's household debt climb to about 45.5% of GDP, driven mainly by non-housing retail loans? And what happens to your EMIs when gold stops climbing and starts to fall? But first, the scale of the problem. India's household debt has climbed to about 45.5% of the GDP. Most of that rising is coming from non-housing retail loans, the everyday stuff, personal loans, consumer durable loans, small business loans taken in personal capacity, and now that includes gold loans. On the surface, the banking system still looks healthy. Gross bad loans are around 1.8% for banks. Borrower profiles have improved, more prime borrowers, better bureau scores. So at the system level, nothing looks broken. But that figure of 45.5% of GDP tells us something important. Borrowing is becoming a much bigger part of family finances. Retail loans, loans taken by ordinary people, not large companies, stood at roughly about 170 lakh crore rupees by March 2026, up by around 16.5% year on year. Loans used for consumption, personal spending, appliances, vehicles, education, and daily household needs were about 119 lakh crore rupees, up roughly 15%. The key shift? Non-housing retail loans now account for 58.4% of total household borrowing. In simple English, that means household borrowing is increasingly not just about buying a house. So this isn't just more people walking in and taking loans by depositing their gold. Even the average ticket size of a gold loan has roughly doubled, from under 1 lakh to nearly 2 lakh in a couple of years, as collateral values rose. Same jewelry, much bigger loans. So why did this pile explode?
Between March 2024 and March 2026, India's gold price index nearly doubled.
In Delhi alone, 24-carat gold peaked to 1.8 lakh rupees per 10 grams in late January 2026. By early July, it had slipped to 1.4 lakh rupees, roughly a 20% drop in just 5 months. Add a second driver, regulation. When the RBI raised risk weights on unsecured personal loans and credit cards, banks became more nervous about lending money with no collateral. So they pivoted harder towards secured lending. And what's more secure from their point of view than the gold jewelry you already own? Put these together and you get exactly what we are seeing, a boom in gold loans. But why does a fall in gold prices frighten the gold loan lenders? Well, two reasons. One, growth stalls. Banks can no longer rely on rising collateral values to grow the book. Every new rupee of lending now needs a new borrower. Two, the safety margin shrinks. If a lender gave you 80 rupees against 100 rupees worth of gold, they were comfortable. But if that gold falls to 85 rupees, the cushion is thin. The RBI has explicitly warned that rapid or prolonged corrections in gold prices could weaken collateral protection, increase borrower stress, and raise delinquencies and payment defaults. We've seen a version of this before. When gold prices fell in 2013, even a 10% drop in price cut gold loan growth significantly and hurt profits later. Now, lenders have shorter loan tenures and lower loan-to-value ratios, which strengthens their cushion. But the gold loan market is much bigger and more crowded than it was then. At the household level, debt stress rarely starts with one huge loan. It often starts with a small appliance EMI, then comes a two-wheeler loan, then a personal loan, maybe even a credit card balance, or a business cash gap funded in somebody's personal name. And when money gets tight, the family looks at the gold in the locker. That is why a gold loan has to be read twice, once as collateral for the lender and once as a clue about what is happening inside the household budget. One loan can look fine, but 5 loans all coming out of one salary, one shop's earnings, one farm income, or one small business, that is a very different story. On paper, India looks fine. Household debt is about 45% of GDP. Bad loans are low. Gold loan portfolios still look healthy. Microfinance indicators have improved. Retail credit overall appears stable. But look a layer deeper and a different picture starts to show up. Gold loans are getting larger, especially ticket sizes above 2.5 lakhs. More borrowers are coming back as repeat gold loan customers with higher exposure per borrower. Some unsecured segments are flashing early stress signs, even though headline defaults remain the same. The point is simple. You won't see this risk in one big number. It's building slowly inside households as people stack different loans over time. So what does it mean for you, our viewer? Before you pledge your family gold, ask 4 questions. Is this for a one-time emergency or am I using it to pay an old loan? Can I repay it from my existing monthly income without borrowing again? If my income falls for 3 months, what happens? And last, if I cannot repay, am I truly prepared to lose this jewelry? Because the gold loan ad that shows you how much you can borrow does not show you how many other payments your income is already dependent on. The real collateral is not the gold in the vault, it's your next month's income. And if that income cannot carry every EMI already on the table, no rising gold price can fix that problem forever. If this video made you look at your EMI list first before looking at your jewelry box, like this video, share it with someone who thinks a gold loan is always easy money, and subscribe to Decoder. Because the most expensive loan is the one you keep calling temporary. See you soon.